Hello, everybody. Welcome into today's live stream. This is going to be an exciting one. We have David Jacansky on from Quantum Chaos, Quantum ETFs, everything that you're doing over there. I love to see it. We've had so many conversations around Btgd, and today we are going to be talking about Bitcoin and gold and stacking them together into a single ETF and why that is one of the best performing products of this year, but the run is not done. If you're interested in this, please go to the website. We're going to be showing parts of it as well. Just for those that want to find it, it's quantifyfunds.com. And you can see all the several ETFs. We're super excited to be working together with David to spread the word on this. So without further ado, let's jump right into this. This is really surrounding the topic of currency debasement, and that has become far more prevalent in the last 5 years than ever before. Obviously, with the Fed printing a quarter of the money supply back in 2020, and really seems like they have intention to continue to do so. You also have a lot of instability caused by tariffs and Trump and other pieces. So everything is just a perfect storm for what you've created, David. So welcome to not really the podcast, the live stream here. I'm super excited to hear your thoughts as to, first off, how this came about, the thought process here, and what your thought is in investing in a product like this in this current environment.
Absolutely. Thank you so much for having me. It's been a very fun ride since our launch in October 16th of the stacked 100% Bitcoin to 100% gold ETF, ticker Btgd. Try to keep it very straightforward, BT for Bitcoin, GD for gold. This concept of stacking two assets on top of each other is called portable alpha. It's been around for decades. It started off first available to retail in a mutual fund format by PIMCO decades ago with the PIMCO Stock Plus Fund. So we launched mid-October in partnership with the Return Stack folks here with the Bitcoin and Gold ETF. It's an actively managed ETF that rebalances Bitcoin and gold to target 100% exposure in both assets. You can think of it as a 50-50 mix times two. And as you alluded to in the onset of the call, really what we were trying to do is prepackage two assets that, where do they fit in your portfolio? Are they alternatives? Are they commodities? Are they store value assets that fit within your alt portfolio, and do the difficult rebalancing for the end user and the end shareholder within the ETF in a cost-effective and tax-efficient manner? That is the ETF wrapper. They've been two asset classes that I personally, who I spent about 11 years prior to founding Quantify Funds with Title, have been invested in. And I find that a lot of people don't actually do the very difficult rebalancing between these two assets. That actually causes a whole lot of value. And I think, as you alluded to, especially in the last 3 months with everything going on with tariffs, people are more concerned than ever, not just about the stability of the US dollar, but really about all paper currencies. I think, we are one day removed from the market's reaction on the ratings downgrade of US credit. And the most interesting phenomenon that came of that it wasn't just US credit that got hit. It was all developed nations around the world. Their long duration bonds all got hit simultaneously. So it was almost a recognition that, oh my gosh, this concept of storing value in your currencies is just not something that we can expect for long term, which quite frankly has been the case for the majority of history. And what we've seen over the last 15 to 20 years has really been this anomaly with rates being so low, inflation being so low. It was the tail end of the globalism movement. We squeezed out every bit of margin in every supply chain we could find and made it as efficient as possible with as little friction as possible. And now you're seeing, right as we have a demographic problem, right as we have a debt problem, those frictions arise. And those are not unique. They are correlated, right? The inability to see the bubble growing bigger for all makes everyone try to grab to what they have a little bit more. So that's where this protectionism movement is coming from all countries around the world. US is one of the leaders in that right now, trying to onshore a lot of our operations, trying to balance trade deficits with other countries and make them come a little bit more in line, or at least make it a little bit more fair. And so all of this will lead to, in some form, more printing, right? Whether it's traditional inflation or stagflation, which is essentially inflation with lack of wage growth. All of this will likely erode the value of our currencies even further. One of my favorite stats specifically on gold is if you look back about 100, 150 years ago, and you tried to buy a house, or you tried to buy a suit, or you tried to buy a car, the value in that asset actually really hasn't changed significantly over hundreds of years pricing gold, right? That suit in 1905 cost you the same amount of gold then as it does now.
David, did you see my tweet about this? I tweeted this
I
last
didn't.
week.
No, I didn't see that.
Oh, okay. I was gonna say, like, you're taking all the same stuff. I literally had a whole tweet. I was like, hey, you look back at it, right? A suit, even like some other things, like the amount that you pay for a haircut, right? Different pieces like this, like some of the things really have stuck in the gold pricing.
Yeah, yep. And gold, and I think one of the key metrics there that is not often discussed, and you've heard me discuss this before, is the supply. They find about 1.75% increase in supply in gold in the ground every single year. That was a much larger number in the world of QE when rates were so low, but now where rates are and how much we are printing continuously, that is a significant supply constraint. And actually, we find ourselves in a position right now where, especially because of this movement in the last 12 months, gold has outperformed the S&P 500 over the last like 5, 10, 15, 20-year basis, which wasn't the case for a long time. There's a lot of gold bulls that have been really, just holding on, permanent portfolio allocators, holding on to the gold allocation for a long time, and it all paid off right now.
Pulled it up, by the way, just to show. I'm not lying. Look at that. Talking about, but I said back in the day, get you the toga. They didn't have the suits just yet.
Thankfully, I'm not exposed to the price of haircuts, so I don't even know what those cost anymore.
Yeah, he's inflation proof.
Haircut inflation proof.
I really like that you brought up the Moody's piece of this, because to be honest, when I was thinking about this, I hadn't even really factored that in. But that's a additional kind of buffer that people should want to have, right, to the currency, is saying, well, not only is the dollar weakening, but the entire credit of the U.S., right, that whole system is getting weaker, and that's bullish for these alternative assets like gold and Bitcoin. And really, and I want to talk about the two pieces here. Gold, obviously, you mentioned right there how much is being found each year, but then Bitcoin, right, that's about to basically end. I mean, there's really going to be no more Bitcoin mined after 2040 at that point, and it's even minuscule for the next 10 years from 2030 to 2040. So you have even two very interesting competitive systems who are never going to have their credit downgraded, right? Who are never going to mass print 25% of supply, God willing, they don't find that much gold. And so there's just like some of these ideas, right?
Yeah, I mean, so U.S. listed ETFs are a little bit in Bitcoin are a little bit over I think 14, 15 months old at this point. U.S. listed ETFs own over 5% of all Bitcoin that will ever be printed. BlackRock's Bitcoin ETF owns over 2.5% of all Bitcoin that'll ever be minted, and MicroStrategy owns another 2.5% of all Bitcoin that will ever be printed. So it's a very different asset today than it was even just a couple years ago, but especially 10 years ago. At certain points, the mining rate on Bitcoin was 15%. The new supply coming to market was so high, so you had to have 15% increase in demand. So the base of believers had to grow by 15% a year to keep up with just what the supply was from mining. That's not the world we're in today. Post-halving, Bitcoin mines at 0.86% a year, which means the supply of new available Bitcoin increases by less than 1% a year. And if you look at the rate at which ETF listed assets are picking up Bitcoin, obviously I mentioned MicroStrategy. That's not even to mention central banks, right? The other thing that is a problem when you aren't unsure which currency and debt you can trust is that central banks start to reconsider what they consider in their reserve pool. And so while it's been other people's currencies and debts and gold, you're seeing a lot more consideration for the adoption for Bitcoin. And it's funny, a lot of people say, when is Bitcoin going to show true defensive characteristics? And it has sometimes, right? It showed some defensive characteristics around Silicon Valley Bank. It actually showed some in March this year as well. It might not have had a negative correlation to the Qs, but at least its magnitude of movement on the downside was dropping significantly. And what I mean by that is, if you ask anyone last year, the naysayers in the Bitcoin world, they basically tell you that Bitcoin was TQQQ, Bitcoin was triple Qs, right? But that wasn't the case in March. Bitcoin on the downside was like maybe 1.2 times Q. And that is very significant because you're seeing the correlation from Bitcoin. Really, it's obviously somewhat tied to global liquidity and risk assets, but also gold. And that fluctuation provides a lot of value, especially for what we're offering here in this stacked Bitcoin and gold ETF to allow us to rebalance between the two. We're a little bit biased, but I almost feel like Bitcoin and gold is the new 60-40, right? You just kind of rebalance between your growth asset of choice and your defensive asset of choice. And at the time when, people are going to actually see that true stability and removal from correlation to risk assets in Bitcoin, the price will be a whole lot higher, right?
Do you have an inherent lean to one versus the other? I mean, we talk about the purposes of each, but gold versus Bitcoin, do you feel like you lean to one more?
No, I mean, I think a lot of my path in the investment world has been trying to decipher and determine scarcity assets, whether it's land or in this case, Bitcoin and gold, finding things that can't replicate at fast rates. And I know I sound a little bit like a broken record there, but I think I'm a little bit indifferent between the two. And I think it's really hard to, even personally do the rebalancing between the two, which is why I force myself to do the rebalancing by allocating through this vehicle. I think being emotionless with your rebalancing, we were actually on a podcast yesterday talking about this. Like, if you don't have something in your portfolio that isn't doing well, you're probably not diversified. And you should probably also be rebalancing into that asset that's not doing well from the one that's doing best. And that's really hard to do. And so to take a step back and put into context, like, what is different between stacked assets and traditional leverage ETFs, these are intended to be held for the long run. They can be trading vehicles and traded for a short period of time to hedge a Fed meeting or something like that, or hedge a weekend, whatever is going to come out from rating agencies and Trump, et cetera. But they do not have a daily disclosure in their prospectus that these are intended just for daily use. So we market this as leverage for the long run. And that's because of this rebalancing. We get to teeter-totter and rebalance between two assets that are not perfectly correlated. Over time, they have about a 4% correlation that fluctuates between negative correlation to positive correlation. But there's usually ample opportunity there to rebalance between the two. So I like to be emotionless, especially with my alts. So I kind of feel an equal allocation to both is warranted.
Good. Okay. I appreciate that. Before I go and move over and take a look at some of the website, I'd like to just bring Evan into it for a second. Evan, if you want to, sorry, I'm moving some stuff around. Here we go. If you want to share any thoughts, questions here, and then we can take a look at some of these graphs on the website.
No, yeah, I'll share some thoughts after. I just want to start here on I'm curious on who. I feel like the Bitcoin and gold person, they might have the same thoughts about the direction, but that type of person who's interested in Bitcoin tends to be very different than that type of person who's interested in gold. So I'm curious on the demographics you see. Obviously, you're talking about these assets, and I'm imagine maybe all your questions about the Bitcoin side come from 20-year-olds, all your questions about the gold sides come from the 50-year-olds. So I'm just curious, as someone who's these two different assets that are maybe targeting two different people. I'm just curious, the type of conversations you're hearing. Is it a lot more of they have so much in common between Bitcoin and gold versus more that they have on differences? Because I'm sorry for a really long question here, but I think of a Peter Schiff on Twitter. This guy hates hates Bitcoin, loves gold, loves to go at it. We have a Michael Saylor on the other side. Whereas I think that they might be very similar. I'm just curious on what you're seeing there.
Yeah, so there's definitely a demographic shift in terms of looking at gold or Bitcoin as your primary store of value. But I do think that the traditional, I think Sailor is a perfect example. I think the Bitcoin adopters of that generation came from gold allocators, right? The ones that saw Bitcoin's initial value came from gold allocators specifically because they saw the supply cramp, and their whole world has been looking at like demand versus future supply, and understanding that if this demand keeps up, the supply will do everything it needs to bring this price to a massive level. I think for greater crypto, you are right that it skews younger, and that's more the application of crypto products and blockchain and things that can be built on blockchain, etc. But I think specifically, and that's why you've actually seen Bitcoin do so well relative in certain cases to other cryptos. Everyone's been waiting for this second leg, this alt season, right? And we've had like some hints of alt season in the crypto world, but always seems to like start off and then putter off. And you've seen time and time again with Bitcoin hitting $100,000, I think about 7 times over the last like 5 months. I think until the last one, every time Ethereum's price was a little bit lower. So I actually think that demographically, there is a different way that the older generation looks at crypto X Bitcoin and Bitcoin. So I think Bitcoin has separated itself within the crypto category for the older generation. Whereas, yes, the overall adoption of crypto and everything that's to come with blockchain is definitely demographically skewed much younger. But I do think there are many allocators, because a lot of the people in this generation, you know, in the boomer generation, in the millennial generation, that have allocated to gold for a long time, that were early adopters to Bitcoin, I think they were early adopters because they saw the connection on the supply side more than anything. Because, you know, if you think about crypto, it's in theory somewhat of a store of value and a network, right? And Bitcoin is more specifically just on the store of value side versus the network effect that it creates. And so I do think you're right, there's a demographic shift there. But I do think a lot of the allocators who have maybe not stepped into the entirety of the crypto space, but really were early adopters in Bitcoin, they oftentimes, I think, have it sat right next to gold in their portfolio. And even they, I think, could use a product like this, because doing the emotionless rebalancing is really hard to do. Like, were you buying Bitcoin during the crypto winter? What assets were you selling to generate that cash? Were you trimming Bitcoin when it was racing up to 108 the first time, right before it crashed down to right below 80,000, and gold was roaring to an all-time high? And now we're seeing almost the opposite of it. In the last couple of weeks, we're almost seeing a day or two swings where, like, you know, Bitcoin and gold will go in one direction, and then 2 days later, it'll like teeter-totter back and forth. And I think you're seeing the commonality of the investment theme grow over time, because everything that's highlighted in this world today with tariffs is bringing it front and center. So like I said earlier, a lot of people question, when is it going to always show this true store of value? Well, gold's the first asset class that doesn't always show a true store of value. What I mean by that, sometimes it's a second effect store of value, right? Gold, during much of the financial crisis, actually had, at least in the second half of the financial crisis, had some drawdowns. But it was really the printing engine that was the second derivative effect of the market crash, and how we climbed our way out of it with all of this additional debt and quantitative easing. That really was that long-term booster for gold. And I think that catalyst of like that second derivative effect, well, we will still only get out of this through quantitative easing in the future, is what always is further linking Bitcoin and gold together.
Any other follow-up there, Evan?
No, that definitely makes a lot of sense there. That first kind of order effect, you don't know how the correlation is going to end up holding up there, but that second order is they're going to get the benefits from it. I was going to kind of ask around, you know, that correlation and how it changes, because obviously there's times where it feels like Bitcoin is moving with it. Maybe Bitcoin's the one that's changing more than gold is, the correlation there, and that's what's happening. But there's times where it feels like Bitcoin is a very like a NASDAQ type tech hedge. And there's times where it starts to go a little bit opposite. My curiosity would be like, once we're hitting the extremes, how often do they tend to trade together versus trade differently? You know, we had like that April 2nd Liberation Day, even that like Japan yen carry trade. I'm curious on how the correlation changes in these extreme moments. I don't know if you have that data.
Yeah, so over time, if you're looking at like a 6-month rolling correlation chart, and this is on our investment deck, which can be found on quantifyfunds.com, we compare rolling correlations between S&P 500 and Bitcoin, S&P 500 and gold, and then Bitcoin and gold. at its most extreme, the extreme ends of the 6-month rolling correlation between Bitcoin and gold have been almost negative 60% and as high as almost positive 60%. So you are right that it does tend to like typically fluctuate plus 20, plus 40, minus 20, minus 40% in that range there. But what we feel happy to have seen in the last couple of years is that the time when the correlations kick in is just like we're seeing right now. Not to sound like a broken record, Silicon Valley Bank, tariff talks, downgrades. You're seeing it in a time when people are putting into question the current state of currencies and debt and just the economy as it's built today. And you're seeing it divert, in our opinion, much more when it's just a risk-on rally and there's no fear to be had. And I think that's almost more because gold is trading more, or people are using gold more in their portfolio as a true replacement for something like duration, treasury duration, TLT, the bond side of their portfolio, the stability side of their portfolio that's supposed to be negatively correlated to their equity side. And so it makes sense when there's no big risks or concerns in a day or a week that stability asset might retract a little bit. And this asset that still has some correlation to QQQ and just overall global liquidity will rise with liquid assets as capital flows into it, because that's when people are allocating to Bitcoin ETFs. That's when people are like, okay, I'm going to now take my first stab into this new asset class. And I think that's, beyond just retail in the ETF space and MicroStrategy and the central banks, as we discussed before. It's also the RIAs that we expect to have much more adoption in it in 2025, 2026. You actually saw BlackRock come into the year in 2025, issuing in their asset allocation models a range of 1% to 2% allocation into the Bitcoin space. What are the odds that their range of allocations is not probably at least 150% to twice as large going into 2026? So we expect this continued drip in adoption to, again, it might happen more in calmer times because that's when people are usually more willing to make these changes in their portfolio. Sometimes a lot of the advisor world will just kind of wait and see what happens in these volatilities. They've been through this many times and they know rebalancing in the middle of extreme of a drawdown can be very difficult. They're kind of waiting to see things level out and calm down a little bit before they change their portfolio. But when things are calm, that's when they're adopting new theses or they're willing to try something new in their portfolio. So very long-winded answer to get back to your original question of, I think in times of uncertainty, we're seeing the two correlate much higher together, which in my eyes is exactly what it's designed to do. But again, their correlation we expect will continue to trend towards each other over time, but that might take 10, 15 years.
Yeah, it makes sense to me. I want to first off shout out to everyone that's tuned in. We have a little bit over 6,000 people who have tuned in to watch so far. So appreciate that. I think that if you're in here, you're doing yourself a service because these are two of the best performing assets on the year, and not enough people have a deep, detailed understanding of why they are the best performing assets on the year. And that's really what I think we're digging into right here. Let's take a look real quick at the website as well. So first off, I'm going to go to the regular website, then I'll go over to the other details that we were going to discuss. So just taking a look here, I encourage people to come and jump into quantifyfunds.com. This is where you can go ahead and you can see all the different ETFs as well, right? So Btgd is the main one that we're talking about today, but there are several others that are already live, and then there's several others that are going to be coming. There's some good explainer videos on some of these pieces, and also it runs through, right, the things we're talking about: inflation hedge, currency defense, market volatility buffer, backed by a lot of great data as well, right? So that's kind of the important thing. They're not just saying this. Sub 1% expense ratio, like to see that. Outside of that, I think that it's good to jump over to this next page. So I'm just going to go ahead and share this tab. So right here, David, walk us through what we're looking at when we talk about, the case for stacking Bitcoin and gold, because this is a lot of people, right? They always hear about ETF and they go, well, why don't I just, go buy one or the other? Or why don't I just buy them myself and, deal with rebalancing, which good luck on daily rebalancing. But just curious your thoughts here.
Yeah, so the subtitle to this paper is "Innovation Through Stacking: Leverage for the Long Run," and so this is a since inception chart that you're seeing here. This risk reward chart since the inception of Btgd, comparing us to one of the largest gold ETFs, one of the largest Bitcoin ETFs, one of the largest 2x gold ETFs, and one of the largest 2x Bitcoin ETFs. So the green dots are the gold, and the yellow dots are Bitcoin. And you can see, at least at the snapshot in the context of when this was posted, BTGD is outperforming both 2x gold and 2x Bitcoin. Significantly less risk, obviously, than 2x Bitcoin, and just a hair more risk than just Bitcoin alone. I actually think traditional leverage ETFs sometimes do get a bad rap about their leverage expectations over time. We all talk about the path dependency of them. If you hold a leverage ETF in your portfolio and you regularly rebalance it, you can get very close to your intended leverage target. So you can hold 2x Bitcoin ETFs and get close to 2x Bitcoin, but you need to regularly rebalance in your portfolio, which means in extreme up movements, you're going to be trimming it, and in extreme down movements, you're going to be buying it. Quite frankly, that's just very hard to do emotionally for retail, and in practicality, that's very hard for advisor practices to do. Advisor practices oftentimes aren't really built to do 3 to 4 rebalancing periods within a week. And so that's why you don't see mass adoption from leverage ETFs from the advisor space. It's a combination of difficulty of frequency of trading, and then also just a prospectus risk. They say they're not intended for daily use, right? So it puts the advisor practice at legal risk to hold that period overnight and go exactly against what the prospectus is saying. So that's one side of the coin. The other side of the coin is we know all the best institutional investors use some form of leverage. Doesn't mean you need to be 3x Qs. You could have 120% total exposure, whether you're an endowment or an institution, et cetera. The added gross long that you're going to get leverage exposure on should diversify the rest of your portfolio. But if you're not capable of doing that regular rebalance in a leverage ETF, choosing a stacked product like the Btgd Bitcoin and Gold ETF, ticker BTGD, does that rebalancing for you and allows the vehicle to have much less path dependency. And that's why you're seeing here us at, as of close to the end of April, higher returns than 2x Bitcoin, higher returns than 2x gold, just a hair more risk than Bitcoin alone. And that's because the Sharpe ratio boost of rebalancing between these somewhat uncorrelated two assets. And so this is why, again, leverage for the long run, this is built to be used in a model allocation sense. Also short-term trading, but you can hold this and rebalance it in a regular frequency with the rest of your rebalances, whether it's monthly, quarterly, once a year, et cetera, because it removes some of the underlying path dependency.
I almost want to call this the Adam Smith ETF, right? It's low supply, high demand.
Yeah.
And that seems to be what makes it work. There's one other chart here on the next page as well, talking about the gold returns during the Bitcoin drawdowns. This is the other one that you were referring to, right?
Yeah, there's a lot of charts that have gone around Wall Street on gold's ability to protect and drawdowns in the S&P 500. And what we wanted to show here is that holds true for Bitcoin as well. So this chart shows every 15% drawdown in Bitcoin and how gold responded during those periods. You can see even during the crypto winters, gold held up relatively well. Gold was actually up in the first half of both of those crypto winters. So the negative correlation held in place during those periods. And obviously in our last two plus 15% drawdowns in Bitcoin that we've seen, one being this year, gold held up phenomenally well. And so again, this is why you leverage two assets that are unique to each other, because when you have the same asset leveraged on top of each other, you know, if one goes down to 80%, the other goes down to 80%, right? That's a almost blow up risk for a leverage ETF. But by having one of your stacks have some defensive characteristics to the other, it allows that rebalancing to smooth out those drawdowns and give you more upside in more volatility in the upside than you do necessarily get volatility in the downside.
Very nice. Well put out. Evan, do you have any thoughts on these charts, some of the data that we're looking at?
Well, the last chart I saw, it ended April 23rd, so my stuff is going through. There's no way
It
this
is up
isn't up
another.
more.
It's
Exactly.
up another
Yeah.
11%. Btgd is at
Yeah, 12.
71%.
Yeah, I so as of today,
72. Sorry, still going.
we I think we just crossed almost 75% since inception intraday today.
Yeah.
As of today, 2 times Bitcoin is, I think, a couple percentage points ahead of us. But
It has
again,
been moving.
it's been moving. But there were, if you looked at that at some points when Bitcoin was at like 82,000, that thing was down 12% since inception. And so again, it's a much harder asset to hold in your portfolio legally by prospectus. It's not intended to be held in your portfolio. So if you're going to rebalance often, it's a great vehicle, but this is a allocator's version of allocating with leverage to both Bitcoin and gold and taking some of that emotion out of it. Honestly, I think you could make a case for owning some Bitcoin, some gold, and some BTGD in your portfolio. Have 2 unexposed and a portion of it that rebalances between the 2. That's okay too. But if you are not trimming the extremes of any of your volatile assets, whether it be leveraged or unleveraged, you need to find a vehicle that will do that for you to remove that emotion from that process for you. So they do it for you because hindsight is 2020. If you look at like 2021 and ARK is beating everything, well, were you rebalancing out of ARK and into your energy stocks and your value stocks? Like exactly, like those rebalance. It seems much easier with foresight to make those moves, but like when you're actually live in it on a day-to-day basis, selling that darling that's going up so much and making you so much money is not an easy thing to do.
Well, okay, so this brings you back. This is definitely a thought process that I want to get your insights into as an actual fund manager, because retail gets conflicting messages. I think there's a lot of people that hear, pull your weeds fast, let your winners run. And then I'm hearing more fund managers that are on the other side saying, no, you have to, actually invest in the ones that are lagging behind, right? And that's where you need to sell some of these winners and move the funds over. So how do you think about both sides of that?
Yeah, one's a momentum trade and one's more of like a mean reversion value trade, right? So I would say that there are 2 factors that both over time add value. It's really hard to be the momentum trader. If you're trying to build a complex system that's going to time the market, you kind of have to look yourself in the mirror and say, who are you competing with that might be doing this a little bit better? But we had a 15-year stretch where momentum was the best performing factor, and so that makes a whole lot of sense. We were on our Twitter Spaces with you all yesterday, and Meb Faber was talking about global asset allocation. There's deep value funds out there with single-digit PE ratios. So it's momentum did very well for a period of time, and there's a case for that to be had in your portfolio. But most true like institutional investors would tell you like, okay, that's one factor. You also need your value factor. So you need something that's rebalancing back to whatever has performed worse, that you still have positive expected return expectations on that asset class. And so you need a little bit of both if you're really trying to be tactical. I would say it's a lot easier without complexity to be a good value manager than it is to be a momentum trader, because momentum is all about speed, and you have to ask yourself, especially if you're running an advisor practice, like is looking at just the 200-day moving average, is that fast enough? Are you making these trims fast enough, or does the entire institutional hedge fund world know exactly how many retail investors are thinking about the 200-day moving average and factoring that into the momentum calculations that they're doing on top of all this amazing flow data that's out there? So I would say, there's a reason to have momentum in your portfolio. It's even more effective in an ETF. But again, structural diversification through leverage is beneficial to that. One of the nice things about stacking is it's almost, to steal Corey Hofstein's words, addition without subtraction, right? You can add to your portfolio without having to take away. So I'm like, keep your equity allocation, right? Keep your whatever your allocation is. Find leverage in somewhere else in your portfolio that has the potential to diversify against that leverage asset. Which, let's face it, at this point, the S&P 500 is, at least over a longer term, very much the momentum trade and vehicle of choice, or maybe the Qs are. But like market cap and momentum have definitely coincided albeit I'm sure there's rebalances coming in some of the momentum ETFs, given the underperformance from the Mag 7, and we'll see some serious rotation there. Yeah, hopefully that answers your question.
Yeah, that was great. I'm curious, as you've talked with advisors, where do they see this fitting into, or where do you see it fitting into a potential retail investor's portfolio? And I'm kind of talking about, by like sizing, as well as what's the goals and the pieces that it's solving, right, for someone's portfolio, where they say, I hold this, Btgd, let's say, I hold this amount, and here's what it does for me in relation to the rest of my portfolio.
Yeah, obviously speak to your financial advisor, and we're not giving investment advice here on percentages, but we've heard from advisors allocating anywhere between 2 and 10%. Obviously, the higher allocations are to the higher risk model portfolios out there. But this is an alternative. This is an inflation hedge. This is in addition to sitting next to or replacement of your commodities fund, right? This is sitting next to your managed futures fund. This is a way to, as you know, not to sound like a broken record, but find a store of value and an asset that, like the S&P 500 is so tied to the strength of the dollar, that find an asset that can do well if the dollar is faltering. I think that's the other thing we've seen in the last 6 weeks of market trading is down days are no longer up days for treasury bonds, right? Mm-hmm. It used to be the flight to safety went to treasury bonds. And now people are putting into context our downside volatility days are looking much more like an emerging economy where it's a flight of capital out of the country. And that means the stock market, the bond market, and the dollar all get hit at once. And that's what we saw again yesterday. That occurred during the first a drawdown during tariffs. And so again, where are you going to find correlation benefits in your portfolio? If it's not your bonds, it's your alts. Is it going to be some tactical fund? Is it going to be structural? Do you feel oil and basket of commodities is going to provide that over a long period of time? Or again, scarcity assets that the government cannot print and replicate and grow in supply. And so again, that suit's going to cost you the same amount in gold today that it was 100 years ago. And that's something that's worthy of an allocation in an alternative sleeve in your portfolio.
Yeah, I like it because obviously, it's simple and complex at the same time, yeah. Right? There's complexity in the fact that we've been talking now for over 30, 35 minutes, and we're just uncovering layers and details. But it's simple as in, I speak to my friends who are, not avid stock market investors and people, and this is very easy for them to comprehend why this is a valuable ETF. Very easy for them to comprehend, right? They can look at gold, Bitcoin, and I just tell them, I say, hey, look at the dollar, look at the devaluation of the dollar, right? It's going down. Look at what's not going down, right? Gold, Bitcoin. It's pretty easy for people to look at and just put 2 and 2 together. I think that the value and the unique piece is where you're talking about with the stack portion, right? Which is giving people essentially a little bit of leverage, right, on their money right there. And for those that are familiar, again, you're having an ETF where 50% is gold, 50% is Bitcoin, but that's leveraged so that you're getting $1 put in is $1 to each of them, right? So a little bit of leverage there. And we can maybe talk about, how you think about leverage and some of those pieces in regards to retail investors, but pretty straightforward. So you're getting that 2x exposure. And then you're having the constant rebalancing, which, like you mentioned, right, people may lean towards one or the other, but this could have gotten them into trouble, right? Bitcoin is having that huge run, and you were saying, okay, it's time, Bitcoin, 200K. And you're like looking at gold, and you're like, gold, like what's gold gonna do? And then gold goes and it runs 25%, right? And so you only really capture that by having a fund manager that's taking emotions out of it, constantly rebalancing and making sure that you have that equal exposure. And that's how you end up with a really great, year-to-date return in these areas. And when we go back, right, if we look at some of the other pieces, so gold right now is up 23.8% year-to-date at the moment, and it's going absolutely amazing. Btgd up 28.48%, right? So you have a 5% outperformance right there to gold. And then in a similar vein, obviously it's outperforming Bitcoin, which is not nearly up that much this year, right? And so you're actually outperforming both assets, funny enough, right, by having this exposure and leverage. And so that's kind of the magical key to it. Before I come back to Evan for maybe one other question, I'm just curious your thoughts there on how retail investors, because people hear leverage, and leverage can be kind of one of those scary words sometimes, like margin, right?
Leverage needs to be monitored on a
Yeah,
regular
please.
basis, right? So you have to, again, especially when vehicles are saying you should only use this on a daily basis. What does that mean? You should reconsider this at the end of every single day and at least consider resizing it into your portfolio. And that's just, quite frankly, time commitments that not everyone has, that not every retail allocator has, that, as we talked about before, that most advisory practices are not built to rebalance on such a regular schedule. They're just, they're built for monthly, quarterly, and annual rebalancing, not necessarily rebalancing 3 to 5 days a week. So leverage ETFs have been scary to some allocators. They know institutions are building portfolios this way, but they're worried about their ability to, one, from a compliance perspective and an actual feasibility of trading to do it. So this is, I don't want to say, a set it and forget it vehicle, but it is deemed leverage for the long run because of the leverage ETF that you can treat like a regular allocation in your portfolio. You don't have to worry about these day-to-day fluctuations and the crazy path dependency that can be created because of that.
And you don't have to worry about, like, when we look at triple leveraged ETFs and items like this, they're not considered long-term holds because there's erosion, right, over time. But you don't have to worry about that with Btgd, right?
Yeah, I mean, you pay the cost of financing, which we can talk about, right? So, like, what should you expect on a day-to-day basis, month to month, week to week, year to year basis? Like, we actually on our Twitter account just posted about a week ago our performance through April, and from inception through April, Bitcoin was up about 40%, gold was up about 20%, and we were up about like 60%. And actually, we almost outperformed because they were bouncing there. It should almost be the two returns together minus the cost of leverage. And to talk about the cost of leverage, you might say, why don't I just get margin on my custodial account? Well, for financial advisors, getting margin across a book and getting decent rates for any accounts that are less than $10 million is really, really hard. For retail, it's almost impossible to get very good leverage margin rates. You've seen a lot of the platforms make it much harder for retail to access margin. And when they are able to access margin, they're charging much higher rates. Sometimes it's 11, 12, 13, 15% rates, right? That's why prepackaging leverage into ETFs, especially ones that can be held longer, has been so successful. Our cost of margin, we're accessing margin in this vehicle through the futures markets in both Bitcoin and gold. Let's say it's around 5%. So 5% plus 1% expense ratio, you're getting this ETF for free if you consider the cost of margin 6% at that point. What are you able to get on your own through your broker dealer? And by all means, if you're getting much better rates than that and you want to monitor and rebalance your portfolio, you can create the margin on a portfolio level basis. Actually, Michael Green of Simplify has a great chart he shows on this every couple months. But the amount of retail margin has substantially dropped over the last couple of years. That's because these custodians are worried about like the 2008-like environment. They're making it more difficult for retail to access margin. And the ones that are able to access it, they're going to charge higher rates. Well, there's, asset allocation, dollars and investments is like water. Like you dam up one thing and something else opens. And what opened because of that dam? Leverage ETFs, right? They said, oh, well, we can prepackage leverage at a cheaper cost of leverage that you can access and easier to use leverage than you can access on your custodian platform as a retail or building your advisor practice in a model portfolio. Trying to find a model portfolio that actually will rebalance your portfolios with margin on it as an advisor is really, really hard to do. So.
Yeah, that makes sense to me. I appreciate you breaking it down. It certainly gives a lot more credence as to why somebody's not going to go try to recreate this by themselves.
Yeah.
When you put it like that. Evan, we've got about 7 to 10 minutes left. First off, thank you to the 8,000 people who have now tuned in. Love to see it. Let's see if we get to 10K. Evan, any other thoughts here from yourself?
Yeah, well, I think this has been a fantastic conversation. If any of you guys have any thoughts or questions, feel free to throw it in the chat and we can go around to it. I was going to ask around the leverage and how you guys are getting that. You talked about that a little bit in the futures market, so we don't necessarily need to dig deep into there. But I'm curious on kind of like the risks and concerns someone should be thinking about here. Less so about like gold and Bitcoin. Like you guys could do your research into that, but more about like, the construction of the product. I don't know, just anything with BTGD when you guys are thinking about downsides and areas that people should be considering when they're going into this, what they should know. How are you guys thinking about that?
Yeah, I mean, look, the risks are the cost of leverage, right? If both assets were flat on a year, you'd be down just the cost of leverage. Another risk is potential slippage in the futures markets between Bitcoin and gold. We pretty much only stick to front month contracts on Bitcoin. It is active, so we can switch that out and go further out if it makes sense. Front month contracts track exceptionally tight with very, very, very little a deviation from the actual price of Bitcoin. And gold second month contracts or first month contracts, which are every other month, track almost identical to gold. So there's historically been almost no slippage. And this is in, COVID times, Silicon Valley Bank, tariff talks, right? Like how many times you need to test that these are assets that the futures markets are actually tracking really well. But obviously, anytime you're getting exposure to an asset through a future, you're not owning that asset directly, but it also means there's no risk of loss. No one can steal your Bitcoin if you're allocating to Bitcoin here through primarily futures. I do want to caveat saying we do have a couple percentage points in the portfolio in Bitcoin and gold ETFs that allow us to kind of teeter-totter and rebalance sometimes more cost effectively than trading the futures. And so those do have, for example, we have an IBIT allocation for a couple percent. So that does have some direct Bitcoin exposure there. But the futures have been tracking so well, even during very volatile moments, that we don't expect much slippage at all from that.
I also, if I could quickly, I want to ask you like a tax question there. Doing a lot of rebalancing in, if you're doing it in your IRA, that's one thing, but if you're doing it in a non-tax efficient account, that can be very difficult. So I'm just curious on how you guys approach taxes with this strategy and like the benefits it has for me holding it versus if I were to go and do the strategy myself.
Yeah, so we were up, I think, about like 38% in the fourth quarter. We were live for about 2.5 months, and we paid about a 1.5% distribution for taxes at the end of the year. So this is as tax efficient as it can be. We're using a Cayman sub to erode some of the issues of trading in futures contracts, but we are rolling over contracts, so it does have the potential to distribute some taxes. But that's where the active management comes in. We're harvesting losses whenever we can. There's lots of mechanics in the ETF that can make this as tax efficient as possible. There will likely be a very small distribution at the end of the year. But even with that distribution, again, what is your alternative in a taxable account to get that margin? And so a little bit of taxes versus an extra 3 to 5 percentage points of margin costs is the yin to yang you have to consider in a taxable account when considering this. And oftentimes the small potential for a small tax liability is outweighed by the cost of leverage that you're getting in the vehicle. In a retirement account, it's a no-brainer, right? The taxes are not a problem at all whatsoever. So you don't have to consider that at all.
Good question. Okay, really good pieces here. Going to move into some final thoughts as we go down the alley here. I'm curious, looking ahead, let's talk about the general macro conditions that we're seeing. There's still tariff pieces. There's still this Moody's item. So obviously we've talked about, hey, this is what makes up this ETF. It's had great performance. Why should people be confident in, obviously there's no guarantee of future performance ever, not financial advice, but why are you confident in the long-term sustainability and investing in an asset like this?
Yeah. Btgd was up almost 20% in April, right, during this very volatile moment. Had I told you that there was going to be a moment where the VIX spikes to 50, oh my gosh, everything related to Bitcoin is going to be absolutely destroyed. This is just, the Moody downgrade. These are just the first of many events coming this year that are going to highlight the risks that are embedded in our system because of how much debt we have, the demographics in the developed world. A next one coming up in a future date is the debt ceiling debate, right? What's going to happen to our balance sheet once we increase the debt ceiling debate? A lot of economists have talked about coming into 2025 was we were pricing in this insane earnings growth, not just in the Mag 7, but in everything else. Small caps were expected to have double-digit earnings growth after not showing any earnings growth for years, right? Well, tariffs at the very least are going to affect margins a little bit, right? They're not going to pass that fully onto the consumer. So we have revisions in earnings coming down. We have debt ceiling dates. So our equities are looking more expensive. Our debt scenario is probably going to be put further into question. And again, whether it's 2026, 2027, I sound like a broken record here, the supply of Bitcoin and gold are still going to be below 2%. And the supply of dollars are still going to be significantly higher than 2%, right? That's really, unfortunately, the facts. Like Lynn Alden says this really well, nothing stops this train. We're at this like fiscal cliff where we are right now, where the only way we really get out of this debt situation is inflation. We grow the hell out of this and inflate the hell out of it, so this pool of debt seems much smaller in the future. What does that do to the supply of dollars in the world? That increases the supply of dollar substantially. These are two almost fixed supply assets. Obviously, technology, this and that with gold can change. And in theory, we talk much less about the risk of like Bitcoin being hacked, etc. Right. But it's been proven enough that at this point, if it continues as it's going, again, the supply is very little, and the supply of everything else is going to go up. And if you think about any assets around the world that have held their value and their store of value, they're either earning a lot of money, innovating, AI, etc., or it's scarcity assets. So it's innovation or scarcity assets. Scarcity assets, residential real estate, Bitcoin, gold, innovation, NVIDIA, SMCI, all these other companies. So you have to either grow your way out of it or find scarcity assets. And you probably want to, if back to the talk of momentum versus value, I would almost think about it as those two and try to rebalance between innovation and scarcity assets. So, and we're providing this prepackaged, already rebalanced scarcity asset vehicle.
Perfect. That was a great way to wrap this up. Really amazing hour spent here with you, David. I love how you talk about it. You have so much knowledge and deep dive knowledge and understanding of this. And why I think that that's important is if someone's going to run this ETF for me, they need conviction, right? Yes. Like you can't not have conviction. If you're going to run a Bitcoin and gold ETF, you have to have it. Otherwise, it's not going to go anywhere. This is super cool. I love watching it grow. This is something that, to everybody, full disclosure, I personally invested in. I just thought it was a no-brainer. I talked to my friends about it. All my friends who don't know about stocks, they're hit me up. They're like, we're up 10%. I'm like, let's go. Yeah. I think that it's a really cool thing. And so it's something that I plan to hold long-term. Obviously, that's something that hopefully, shows people kind of my conviction. Obviously we're working together, but that doesn't necessarily, always mean that it's at the top of my list. But for me, this is one that is. And so with that being said, any quick final comment in the last minute here before we close out?
Thank you very much for having me. Please give us a follow on Twitter, quantifyfunds.com, and find more information on all of our funds at quantifyfunds.com. We also have some fun trading vehicles outside of Btgd that you can discover on our website. And guys, it's been a pleasure. I think this was phenomenal, and thank you so much for having me.
Yeah, thank you so much. We hit about 8,500 people tuned into this.
Great.
A lot of people learning about Btgd. I think that that's probably the biggest issue here is just discovery, people learning about this and knowing about it. So let's continue to get the word out there. Thank you again to David. Thank you, Evan, for being on. Thank you, everyone that tuned in. Going to go ahead and end the stream here. This will turn into a recording. If you missed the beginning, you can go back and watch it now. Talk soon.